Well, hello there, Facebook and YouTube. It's the Insurance Pro blog here. This is our 10th live stream. And today we are, hold on to your hats. This is riveting today. We're going to talk all about the cash value accumulation test and the guideline premium test. CVAT and GIPT for short. I don't know what we're calling it.
Usually we call it GPT, but you can...
GPT and CVAT. That's typically what they go by. They both have a little different application, and there seems to be some confusion about it, particularly in the agent community. It doesn't come up so much with clients per se. There may be some questions about it from time to time. Speaking, there tends to be a little bit of confusion about the applicability of one versus the other, the advantages, disadvantage. So I'm going to let Brandon tell you all about that. Brandon?
Sure. And I'm going to guess that by the sort of buffering fade out that you just had, most people, including me, have no idea what you just said. So we're moving along.
That's great.
So the discussion of the cash value accumulation test, the guideline premium test, comes up when it comes to using life insurance, much the way we do, where we're focusing on high cash value products. But it also has applications in death benefit focused purchases. Mm-hmm. And it seems strange, I think, for most people that there would be a test to qualify life insurance as life insurance.
Right.
But there's some background here that we don't have to really get into all the gory details of, but there was a time when there was no test. Life insurance was just considered life insurance and no one worried about it. And then life insurers got really creative about how they put life insurance contracts together. And with that, we fell into a world of starting to question if something was life insurance, because we were using some of the tax beneficial features of life insurance contracts to create products that were largely tax sheltering, and various members of Congress and other interest groups decided they didn't like that. And so we put in place new legislation that put some speed limit ramps or signs up on the whole life insurance design thing.
Right.
So this is largely a discussion that comes up with universal life insurance. Whole life insurance is much less impacted by this because there's only one option, and it's very, very difficult to violate the test when it comes to whole life insurance. Okay. All whole life insurance qualify as life insurance under the cash value accumulation test, what we call the CVAT in some cases. And they rarely ever fail that test. So it's not often brought up. But when it comes to universal life insurance, the design of universal life insurance... You would have to force it
to do so, would you not? I mean...
What was that?
With a whole life insurance policy, you would really have to force it to fail the CVAT test.
It's much trickier to do. Right. I would say that it comes up more as whole life insurance policies age. And we start to do different things to them, especially if that whole life insurance policy is blended. There could certainly be some cases of CVAT failure with death benefit reductions, for example, in the future.
Right.
But it's still not an easy thing to accomplish. So
it's not going to happen. It's not going to be a big surprise out of nowhere that hits. No. Because I think that's what people are always wondering. Is this something that's going to bite me and I not know that it's biting me until it's too late?
Right. Whole life insurance by design is just more immune to violation of the cash value accumulation test. Not to make it sound like it's better. That I don't want to mislead anybody down that road. But it's just it has mechanisms in place by its very design that make it less impacted by the flexibility that universal life insurance has, that allows it to be more susceptible to failure.
Right.
So the cash value accumulation test, let's first define that for people. It is a test that very simply establishes a gap, so to speak. So think of cash value, death benefit, and necessary gap that has to exist between the two in order to pass the test. So each and every single year, there is a required minimum space that must exist between the outstanding death benefit and the cash value or the cash surrender value of the policy, and that must be maintained. Now, that amount will decline as the insured under the policy ages or gets older, but there's always going to be a gap that has to exist.
Right.
And that's the cash value accumulation test. It's really not any more complicated than that. The guideline premium test is kind of a two-step test. Number one, there's a maximum amount of premium that can be paid into the policy for any outstanding level of death benefit that exists. And that amount of premium can come either as an annual amount or as a single premium payment. Kind of depends on what your intentions are. And then there is also a gap between cash value and death benefit that must be maintained. However, the gap on the guideline premium test is smaller than the gap on the cash value accumulation test. So, both of them have a gap. Sometimes it's referred to as a corridor. That's just whatever sort of semantics you want to use. The guideline premium test gap or corridor is narrower than the CVAT. So guideline premium test has a smaller gap than cash value accumulation test. But the guideline premium also has a maximum amount of premium that can be put into the policy, and you can't violate that. If you do, you'll violate the test and you will fail the test for life insurance. By and large, the cash value accumulation test is extremely beneficial when someone is looking to put larger sums of premium into a policy under a short period of time in the very beginning. The guideline premium test tends to be very useful for somebody who plans to put a constant or growing amount of premium into the policy. They'll be allowed more premium into that policy for a lower level of death benefit longer term. So
theoretically, you have more efficiency in the cash value growth with the GPT. Theoretically. I mean, I understand that there's a lot of other things that have to happen.
When there's a longer focus. Yes. Yes.
And that plays out in real world scenarios that we've seen.
Absolutely it does. I don't necessarily want to go down the road of when you would use one versus the other today. I think that's better to let that be a standalone subject for people. But we did want to
in a universal life context, right?
Yes, in a universal life insurance contract, context, because there will be no option with whole life insurance. So the really important thing to take away from today is cash value accumulation test is simply a gap between cash value and death benefit. Guideline premium test is a premium test, and in other words, a maximum amount of premium that can be paid. And we should also note that maximum amount of premium that can be paid is looked at cumulatively. So for example, if the maximum annual amount of premium you can pay into a contract is $20,000, and you make two payments of $15,000 in year one and year two. Well, that means come year three, you can put a maximum of $30,000 into that contract. You don't give up those maximums per se. There will come a point when you are limited in later years, but those unused maximums can be carried forward, so to speak, for at least a period of time. So that's the first part of the guideline premium test, and then there is a corridor or gap test as well, similar to the cash value accumulation test, but it is a smaller gap than is required by the cash value accumulation test.
Thereby, again, implying that you could keep the death benefit lower for longer. Just that mechanically. Okay.
That is correct.
All right.
And now everybody knows the basic differences between the cash value accumulation test and the guideline premium test.
Well, there you go. So if that's it, I guess we'll wrap it up here.
Cool.
All right. Don't forget to head over to ipblive.com if you'd like to learn more about our book and the bonuses that we offer with it. It's called Predictable Profits. subtitled The 5 Reasons That Your Clients Actually Want to Buy a Whole Life Insurance. Until tomorrow, thanks for being with us on another live at the Pro blog. And don't forget to head over to theinsuranceprog.com, the thing here in the first place, I guess. I should pitch that. Until tomorrow, have a great day.